What could he have done better? So this is kind of an even deeper dive. So obviously, he's passed on tens of billions of dollars to his kids. But he could transfer another 70 billion plus if he had done more optimization. And this is all kind of some deep dive work that Peter's done here. But there's an important caveat. Obviously, NVIDIA has probably done better than even Jensen imagined over the last couple of years. So it's a little hard to predict that. And also, his goal may not have been to maximize his tax savings and pass everything out to his kids. But we're coming from a point of, if you really want to optimize and maximize this, how do you approach this? So maybe Peter, with that, what are the two things that he could have really done to move the needle here?
Yeah, so the two sort of obvious things are, so he made these pretty large gifts to GRATs back in 2016, but he didn't give away all of his shares. And maybe he couldn't have for practical reasons, but if he had, it would have moved an additional basically $60 billion of assets into trust for his children. And so that would have dramatically reduced his future estate tax exposure. And that $60 billion is going to grow to be, NVIDIA keeps going up like it's going up. It'll be an insane amount. Even if it doesn't, even if it just appreciates at 10% a year for the next 40 years, however long Jensen lives, that'll easily be hundreds of billions of dollars of wealth that he could have gotten out of his estate, but he didn't. My guess is that Jensen knows that his kids are going to get tens of billions of dollars anyways. And so it's just such an extreme situation that he's probably not that worried about estate tax. So like billionaires have a different outlook than people with $20 million. But yeah, he could have done that in theory. And then the other thing he could have done, we mentioned that he made large gifts equivalent today of billions of dollars of shares to his private foundation and also his donor advised fund. What he could have done instead is made gifts to what's called a Charitable Lead Annuity Trust. So a Charitable Lead Annuity Trust, it's like a GRAT in some ways. So it's the same idea. You have a 75-20 rate and you have annuity payments every year for a certain number of years. The difference is, instead of the annuity payments being paid to you, the annuity payments are paid to some charity. And so he could have set up a CLAT and named a DAF, his DAF or his private foundation, as the remainder beneficiaries. And if he had done that, not only would he have gotten the same charitable deductions that he wound up getting anyways for income tax purposes, and not only would he have gotten assets out of his estate, but to the extent that his assets appreciated faster than the 75-20 rate, the remainder, like with the GRAT, the remainder would have gone to his kids. And so depending on the terms of the CLAT, he could have transferred a significant amount, very significant, to his children that way, while still getting the same charitable and tax benefits that he ended up getting anyways.
Yeah. And it's a great, like, CLATs are a great way for people to pass on if you're, again, over the lifetime gift exemption or expect to be. Important and very important caveat is you don't necessarily have to be over the lifetime gift exemption today, but if you expect to be, it can this estate tax planning can be really important. But CLATs are a great way for people who are worried about gift and estate taxes to pass on assets to their kid if you're also charitably inclined. It's like a really powerful combination in that sense.
Yeah.
Sorry, go ahead.
I was going to say, we just got a question from Dennis about CRUTs. And so I don't know if we have time to get into CRUTs and how CRUTs work.
Yeah, go ahead.
I would say the short answer to your question is yes, but also keep in mind the distributions from if you have appreciated assets in a GRAT, those distributions back to you, the annuity payments, aren't taxable. So there's no tax consequences in you getting a distribution. And so if that's what you're worried about, that's actually not gonna trigger any tax. When you go to eventually sell the asset, there will be a capital gain event when you sell. And so you could take advantage of a CRUT in that situation.
Yeah, and I'd say let's play this out for Jensen's situation is he uses GRAT he puts X million dollars into the GRAT. It appreciates a ton. A lot of it goes to his kids. Some of it comes back to him and his wife. If either Jensen and his wife want to sell the shares or their kids want to sell the shares, they could set up a CRUT and sell those on a tax-deferred basis. And so instead of paying taxes when they sell those NVIDIA shares, they can sell them pre-tax, reinvest the money pre-tax, and have it grow pre-tax to, again, create more wealth. You get to avoid gift and estate taxes, keep your lifetime exemption, and then also defer capital gains taxes. And this is where you can stack these structures on top of each other to create even more benefit. you.